Multimillionaire shocking warning for real estate investors. Hello, everyone, and welcome back to another episode at NOVARISE Invest, your channel for financial education. So today, it's a very special episode. Backed by popular demand, we have our very special guest, Baskal Korkis. Welcome to our channel today.
Thank you for having me.
So, Baskal, you were one of our most popular guests last time in our episode. A lot of people have been asking for you. They've been asking to get you back into the channel. You definitely have a lot of value to share with everybody. So we wanted to really show our appreciation today and what you have to offer today. So, Baskal, yesterday, we were talking about the current conditions of the economy. Mm-hmm. And you have shared with me that you anticipate that within the next 10 to 20 years, we're going to experience something very similar to what the economy was back in the 70s and the 80s. For those who weren't present in our conversation, would you be okay with giving them a little bit of an update just to bring everybody up to the same level?
Sure. Yes. So I believe the next 10 years is going to really match 1970s, where we're going to go through a inflationary period of time. But at the same time, we're going to have difficulty with the interest rates at the same time. So to give a little bit better example, in the 1970s, we had home prices go up 4x from the beginning of the period to the end of the period. Where in this time period, over the next 10 years, we're going to have trouble with, let's say, affordability, but we're still going to see home prices and asset prices increase because of our inflation.
It's a very, very interesting observation. And so when we were talking, in addition to what you just shared with me, you also brought up that everyone's experience investing in real estate is going to be put to a test because the majority of the investors that you have come across with are usually familiarized with investing past 2008. And so you mentioned something about how their level of expertise has been mostly pushed towards the offense because they have a market that has worked well for them or worked well in their favor, but the real skills are going to be put to a test if you happen to be somebody who were investing pre-2008 because some of the market conditions were not within their favor. So can you elaborate a little bit more about that as to what you mean with that so that everybody can, just learn more from you?
Yes. So in business world, there's offense and defense. Sometimes you'll have competition. Sometimes the government can even be your competition by making things more difficult for you. So since 2008, after the crash, things got, whoever survived and whoever started then had an easier time period because there was less competition, less people survived for them to be able to compete with them. So you're working with a period of time that you have low interest rates, and that you can grow your company, you can grow your business, you can grow your portfolio with not that many other people being able to step in and compete with you. Now, as that time has gone, people have become quite successful, interest rates have been low, and you can grow throughout that period. Mm-hmm. Well, right now we're getting into a time period where things are going to get very difficult. We have higher interest rates and we have high inflation. So you have both of those things coming against you. A lot of companies that are accustomed to constantly growing and spending every dollar that they have into growing their company will realize that they cannot continue doing that because with interest rates going up means their loans will cost more.
Right.
And now you need to have more profit to make those payments. And if you're in a growing company, most of these tech companies don't make a profit. They break even or lose money. And they're constantly taking on more investors to pay for the difference where they're losing money. Well, when cash flow, during high inflation periods, cash flow is very desired It's a desirable, companies that offer a dividend are more desirable. Companies that have businesses that are hard assets, oil, food, farming, real estate, they're more desirable because they're necessary. People are wanting to invest in those type of companies, not as much as growth stocks. So these growth stocks are going to start shrinking their valuations. And I predicted that a year ago, where I saw that the tech sector is likely going to go down 50%. So people ask me, they're like, where do you see the crash coming? Do you see real estate having a crash? I said, I don't see real estate having a crash. I see that the crash that's going to come is going to be in the tech sector.
Huh.
The only reason that real estate would have a crash is if we have a banking crisis where you're not able to get a loan for real estate. I do see trouble for certain sectors of real estate because if you have a short-term loan right now and it readjusts in 3 years, I think your rates are going to be higher.
Right.
It's going to affect your profitability, which is going to affect your resale value. But I don't see that actually causing a crash. I just start seeing it kind of, you moved sideways. But the real crash, I believe, is going to be in the tech sector based off of the current information we have. Now, let's draw back to the issues that we're having. The issues we're having in our economy is based off of like stagflation. So there's inflation where things keep on going, inflating in value basically. Mm-hmm. There's deflation where things are basically losing value. And then there's stagflation, which in some people's opinions is the worst option. So in a stagflationary environment, the example would be like you have a company and that company produces the same revenue during stagflation. Mm-hmm. But it actually has less sales. So it's actually selling every product for more money. They're charging more, but they're selling less items. So they need less employees. Less employees are making money. So they're spending less money.
Right.
In this, it's this downward spiral of everything costs more, but everyone has less money. The poor are going to get more poor and the rich are going to end up going sideways because even though on paper their money is going to appear like they have more dollars,
right?
The purchasing power of those dollars are going to be worth less. So you would have to spend more to get to the same standard of living.
That's correct.
So that is the problem that I see people are going to have. And that's where most investors today didn't go through 1999 with the tech bubble crash, which we're going to see happen similar things in the crypto space and in the tech space. This doesn't mean that the crypto space or tech space is bad. It's just saying that there's a lot of non-profitable companies that are going to go bankrupt because they're just not delivering a benefit to society. So they're going to disappear. And of the survivors, they should have good growth from that.
Well, that's a very in-depth review update. Definitely learned a lot right now in just a couple of minutes. And given all that information that you know, everything that you just shared with us up to this point, how do you plan to protect your investment? Because in our conversations yesterday, you're in multiple different projects. You're obviously very successful at what you do. So how do you plan to implement the knowledge that you have with you so far and share with everybody like what your plans are in order to preserve your wealth as much as possible?
And I think preservation of wealth is really important. I did take a very complex topic and try to make it as simple as possible. So with the general things people can do to help everybody is one, getting long-term loans. So if you have a 30-year loan on your home, you're doing good. Getting a 15-year loan and having a higher payment is going to be putting yourself in a more of a struggle in case you do lose your job. Because as we mentioned, during stagflation, eventually less people are going to be working. High-skilled people are always going to be in demand, but in general, there's going to be less people working. So you want to make sure that you have yourself positioned in such a way where you have long-term debt, because during that stagflationary period, we could see rising interest rates. So when you lock in a 30-year loan, you don't have to worry about readjusting. That's where my warning came to the real estate investors that have short-term debt. People that have 3-year balloons or 5-year balloons, they have the ability to have very high rates
Right.
coming when they refi. So I would say try to put yourself into more of a 5, 7, or 10-year fixed rate period. Now, obviously, that costs more money up front,
Right.
but that little bit extra money that you're paying could be buying you, basically insurance, cost of insurance to buy you protection. So I would say lock in long-term rates and lock in long-term terms in anything you're doing. Another sector that's going to be, depends on which side of the coin you are, that's going to
Right.
benefit or hurt, is if you have a long-term lease on a commercial real estate, you're going to do well. But if you have, for the owner of commercial real estate, and you have a 5-year lease with 3 5-year extensions, and there's only a 3% increase, inflationary increase on the rent, that property is going to not do so well, because that owner is not going to have a good increase on his cash flow based off of the inflation I believe we're going to continue seeing. We're going to see going forward next year, they're going to release that inflation, it wasn't as bad as this year. This year's inflation, I think that the height hit 8.5%.
8.5, and I believe last week they announced a slight drop at 8.3, which is it's a dent.
Yes. So what I think is going to happen next year, they're going to say next year, oh, we're at like 5 or 6%. But when they calculate inflation, it's year over year. So if we are at year 0, and 0 is just 100%, which is standard. Year 1 is 108%. But compared to year 0, year 2 is 116%. We still went up another 8%.
That is correct.
But when they calculate it, they don't calculate it off of year 0. They calculate between year 2 to 1.
To the next year.
So 116 divided by 108 is going to produce a number lower than 8%. So even though from year 0 we grew 8%, but in reality, they're going to announce it's less, which is going to make them not look as bad, which is going to give them the ability to maybe not raise interest rates or continue raising interest rates, to give off the impression that inflation isn't happening as bad as it truly is. So we're going to have very rough times because interest rates are going to stay decently high. Inflation is going to continue growing, and that's going to increase all of your input costs, all of your expenses, where your income can't grow as quickly because there's not enough people working. So expenses go up, income doesn't go up as much, so your margins keep squeezing. And we're going to be in an environment where cap rates are going to have to increase to make it desirable to invest. So your profit margins are increasing, the cap rates are going to be increasing. So that means your exit strategy, your exit sale is going to be smaller and smaller. And it's going to be creating, not as bad as in 2008, but it's going to create something similar to 2008, where a lot of people were just flipping and they ended up becoming landlords, not because they wanted to, but because they had to, because they couldn't sell. So I think people are going to end up going into this thinking they're going to be flipping this real estate in 2 to 3 years, and they're going to end up being long-term landlords. So I think there's going to be a lot of buying opportunities. Right now, I'm not buying 100 to 300 unit apartment buildings, but in 3 years from now, 4 or 5 years from now, I believe I will be buying those type of properties because they will be more affordable. And it's going to be a good buying opportunity because all those people that just wanted to flip are going to realize they're not going to make all this money in this business anymore. They're going to exit the business, less players involved, better buying opportunity.
Great. Thank you for the great insight. So if I had to recap what you just said briefly, it seems like for those who are looking to buy, the better opportunities seem to be in the horizon within 2 to 3 years from today.
Specifically in larger real estate deals, yes.
Okay.
Downtown core, my bet for the next 15 years, and it's been my bet the previous 15 years, and that's where I've gained so much of my success and wealth, is in this strategy, and I think it's going to be even better moving forward the next 15 years, which is downtown core and secondary and tertiary markets are going to have a significant increase in price. Back in the day, we had the Sears catalog, and it did tons of volume in sales. Amazon took over that concept, where now it's an online catalog. But during that time period, we also had the downtown core, but then the malls in the 80s destroyed the downtown core, took away that desirability to be there because everyone went to the mall instead. Well, now Amazon kind of destroyed that as well. And eventually Amazons are going to be moving into malls. That's my future prediction too. But since the malls aren't there, people still like being around other people. We are humans. We like being around other, humans. So I believe that the downtown core is going to replace the mall. Where kids used to hang out at the mall, they're going to hang out downtown cores. Family are going to hang out in the downtown core. They're going to walk around. They're going to go to the bars, restaurants, movie theaters. They're going to go to different stores. And if you own a restaurant or you own a business in the downtown core, or if you own even rental properties, because I love rental properties in downtown core, I'm going to have affluent individuals living there, working from home, making good money during lunch, walking downtown, seeing people because they don't get to see people anymore, working from home. And then, you know what, this was enjoyable, this was nice. And they're going to go back to their office, work some more. At night, they're going to take their dog for a walk, get something else to eat. And that, I think, is going to be the big trend, is if you capture downtown core in the rental space and small strip plazas and rental properties. So after that trend, I'm going to continue with that trend. During the downturn, during the rougher times, I'm still going to be buying, because those opportunities in the prime downtown properties is going to be a great buying opportunity for you to buy, I believe, very quality assets that are going to go up in value.
You gave us the tour last year when we went to visit you, and it's a testament as to how much you really know and understand your market, and you see the potential. And even in our prior videos, you explained the same concepts about investing in secondary and tertiary markets, and that's why you're here. Like, so far, it's working out great. But I do have a question going back to what you mentioned about the working class, how they're going to be squeezed out of their salaries or their savings. What would happen, or what would you recommend to those investors who actually invest in areas where there are working class neighborhoods? How can they better protect what they have? Should they move to secondary, tertiary markets? Should they stand still, refinance? What's your take on that?
One, everyone, I believe, should refinance and take long-term debt and get as much cash out and hold on to that cash. So that's the one thing. The other thing for those investors is that you should understand that that market is going to go through a rough time. I went through that with my lower income investments, and they went through a very rough time. Understand that's going to happen. Be prepared for that, and probably reposition yourself in such a way where you can bring in Section 8 tenants. So you can kind of bring in the government money so you can have more consistency on that. Those are kind of the small moves I would make that are going to make a major impact. And always vet your tenants, because you don't want to move someone in and have them,
right,
damage a property,
give you headaches and stuff like that.
What I learned back then was no money is sometimes better than money, because if you rent someone a property and they spend, they destroy a whole year's worth of rent and damages to your property, it's better that you just keep it empty one extra month till you find the right person.
All great tips, Baskal. Thank you so much for sharing. Definitely a great strategy, a great way to reposition yourself if you are in that situation. But what I want to do now, I want to move away from this group of investors that we were just talking about, and then talk about those who are smaller. Maybe people who are not necessarily real estate investors, but they're thinking about it. They have some savings in the bank account, or they're exploring the idea of investing in real estate or any type of investment in general. What would you recommend them to do now to protect their savings or their monies until that moment where they can actually find the ideal investment for them?
So great question. As you started, you said preservation of wealth is what you were trying to put on. So if you're buying assets, buy things that are going to preserve your wealth. So you can buy gold, you can buy silver, you can pay for your something as simple as paying for your auto insurance for the full year up front. That's going to save you more money.
Definitely.
All of those things are going to be helpful. So I would say if you're looking to do bigger moves, something more significant, find your group, your tribe, your people you can work with, and do things like syndications and pool together. What a syndication is, where a group of people put their money together and they can start taking on larger investments, because there's an efficiency of scale by bringing groups of people together to accomplish one goal. You can get a lot more done as a group than you can individually. I did it on my own for a long time, and then I started going to the syndication route and joint venturing route, and you can get so much more done, and it's a lot more profit, because now you can do a lot more.
You're doing it at a scale.
You're doing it at a scale where then you can actually have enough profit to pay the best people to work with. So you're stronger and your investments are more secure. So that's one thing I would suggest people looking into, is find who you're comfortable with, because the next 10 years is going to be very, I call it choppy waters. If you're going out to sea, the water's going to go up and down. If you don't have the right team together, you're going to feel all those waves. It's going to be really rough for you. Where if you have the right people on your team and they know how to sail those seas, you're not going to feel that turbulence. And if you have the right team, it's going to be very important to pick the right stock. You're not going to be able to buy a mutual fund and be good for 10 years. I think in 10 years, even if you did go up, say 10%, the inflation went up so much higher that nominally you lost money.
Right.
And I believe that's going to be the same for stocks, for businesses, for real estate investment. You better be very good at picking, even to the right street, your properties. Because if you don't, you are going to come out, even if you broke even, you're going to lose so much to inflation. Nominally, you're going to only be able to buy half of what you used to buy with that same money.
Completely agree with you, Baskal. Thank you so much for sharing with us everything you know. So for those who want to stay in touch with Baskal, learn a little bit more about what he does, learn about syndications, why not? I want to invite you to check out his social media platforms right here that you see on the screen, so that you can connect with him today and the long term. And is there anything else you want to add to our audience today?
Yeah. If you want to learn more about inflation and ways to fight against inflation, we have a 4-part video series. And if you'd like to learn more, you can go to inflation@korcf.com. So just email, I'd like more information. And again, that's inflation@korcf.com.
There you go. You have it. So thank you so much, Baskal, for being with us today. You're certainly making our public very, very happy. And until then, see you next time.
See you next time. Thanks
Take
for
care.
having me.